This is the Trading Psychology Podcast. This is VP, creator of No Nonsense Forex and author of the book No Nonsense Forex Trading Psychology. And with me, as he always is, he is literally half the age of Warren Buffett. That's how young this man is. It is Robb Reinhold.
Wow, that really shows that age is all relative, because all of a sudden you made me feel young when I was feeling old. So that's how I'm going to look at it from now on.
And you should. That's how I look at my age, too. And speaking of Warren Buffett, we are taking a bit of a detour this time around. And if you hate the fact that we're doing this, you can blame me. This is my idea. But Rob and I both have spoken about this a little bit in the past. We really think it's important that everybody here, since you are financially literate, trading has that effect on people, that you do whatever you can, no matter how much money you have on you, to invest some of it, because having it sit there doing nothing is actually far more harmful than risking it in the market, especially if you already have an idea of what you're doing. So Rob and I are going to go deeper into the investing psychology aspect of things. And I'll be honest, Rob, no matter how long this episode goes, and I hope it doesn't go forever because you and I could really go here, not enough time is ever spent on investing psychology. I mean, think about it. With trading psychology, how many episodes are we in now? 73, 74? I don't even know. And we still have more to go. I hate it when creators come out with a psychology video and it's 15 minutes long, or even if it's an hour long. That is not enough time. And we're going to be guilty of the same thing here when it comes to investing psychology.
There really isn't anything out there on investing psychology, because I think their whole point they're trying to make is there is no psychology. There is no feeling. There's no anything. It should just be methodical. Now, that's not how human beings work. We're all emotional. We all have moments. And so it's just not discussed at all, where we discuss it a lot in trading. But investing, they just kind of pretend like you're going to be a robot and do it perfectly.
And that's never the case. I mean, I know it's anecdotal. I know it's TV. But if you remember the show Billions, Wendy was the investing psychologist for the whole firm, and they were paying her millions and millions of dollars to do it because it really is that important. And everybody there has some type of issue that they're trying to work through. So yeah, like you said, you should just be neutral. But in trading, we should all be neutral robots too. Yet 73, 74 episodes into things, here we still are with people listening to our episodes every single day. So let's never not underscore the importance here as we go forward. But Rob, I saw you injected a phrase here at the beginning on our sheet. It says Rob's rant on trading versus investing. So before we officially get started here, let's go ahead and hear what you have to say here, and I'll let you know if I agree or disagree with it.
First, let me get up on my soapbox, make sure that I'm ready to go on this. All right, when I started trading back in the late 90s, when I told people, I didn't want to tell people what I did for a living, because first of all, I was new at it. And also there was a real negative connotation to trading. And whenever you told people you were a stock trader or a trader in the markets, it was always negative. And I got a whole bunch of stuff like, oh, that's just gambling, because on TV, on the financial channels, which was all that was around back then, it was widely said that the only way to make money in the stock market is to buy and hold. That was the only way to do it. And as a trader, traders were just scum. They were gamblers. They were never going to make it. And then all of a sudden, 2000 came along and everyone started getting into trading. And then all of a sudden, when I told people I was a trader, I got people saying, oh, that's so cool. I'm dabbling a little bit too. Let's talk about it. And it got widely accepted as a legitimate profession. And on TV, what happened was they couldn't just jump from trading's okay, or trading is terrible, to trading is okay. So you started to see shows like Mad Money and shows like Fast Money, where, hey, they're talking about trading, but they still did it within this investing mindset, where they'd say stuff like, oh, this is a great company long term. I'm going to buy it here at 50 and sell it at 55. And I'm thinking, what are you talking about? That's trading. That's just trading. And they're like, I'm going to invest in this stock. And then when this happens, I'm going to sell it. And I'm like, that's trading. That is trading. And it has always bothered me that basically CNBC and the powers that be have fused investing and trading together. And the problem is, when you invest like a trader, you're going to blow it. You're going to blow it because that's not the game you're playing. You're not playing the game of getting in and getting out at the right times. That's the world of trading. Investing is you're putting money to work and you're going to leave it there forever. So I want to start off this episode with that in mind. Investing is different than trading. If you're going to be in a stock that you bought it and then you sold it 10 years later, guess what? That's trading. That's not investing. So let's get into what investing is.
Yeah, I think we should, because my definition is going to be a little different. I do agree with your sentiment that it's frustrating when they take something like investing and make it more trading-like. I always say trading is trading, investing is investing. Investing should be long-term. I don't think, whatever vehicle you get into has to be there for the next 12, 15 years. I think you should have the intention of it being there for a while. But that's neither here nor there, really. That's just a definition, and ours are a bit different.
Well, Patrick, I actually want to argue about this now. So basically you're saying time frame. Time frame makes it either trading or investing. Well, what is the time frame? Have we come to a determination as a human society on where the cutoff is between trade and investing?
So I'm looking at the definition of invest right now. It says expend money with the expectation of achieving a profit or material result by putting into financial plans, blah, 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 blah. It doesn't really give a time frame. So if a time frame is not in the definition, then I suppose there really isn't an agreed upon one. So that's all I will go with. As far as what it should be, doesn't really matter. It is whatever it is. I would love to be able to just jump into some of these companies for 15 or 20 years, but I know that things change over time and things develop over time, and sometimes better replacements come in. So if I'm going to invest in AOL, I would love to hold that for 15, 20 years, but it might not last that long. It's just one of those things. So ideally, yes, I think it should be what you just said, but I think there is a little more of a skillful way to play it if you have particular skills. And that's what I want to transition to right now, is that I really think, like I said, no matter how much money anybody has, everybody should be investing. Because if you've been following this channel, or if you've been following any of Robb's material, you understand charting. You understand psychology. You understand money management. 98% of investors out there do not. They might understand one aspect of it, or maybe two, but never the combination of all three. Even if you look at major firms out there, think like a Franklin Templeton or something like that. The majority of people in that building are not actually making moves. Your financial advisor probably doesn't really know how to invest that well. They get the directives from above, and they know how to sell it to other people, and they know how to deal with their nonsense along the way. That's why they get paid. Don't sit there and think it's a bunch of really sharp traders and investors in that building. It's very few. So just know, if you have that trifecta, you are already an elite company. And if you are not putting that to work in the investment arena and not just the trading arena, I'm not sure what you're doing, because I'll say it to Robb, and feel free to counterpoint or expand on any of these points I'm making. Your whole trading investing account shouldn't just all be in trading. Like if you just have cash and then everything else you have is for trading, I think that weighting is completely out of whack. I think that's just going to make it harder for you psychologically to trade if you don't have your money spread out in other places.
I agree with everything you just said. So we are on the same page as far as that goes. When you take a look at investing, one of the things you just said was diversification. And this is one of the things I know that I want to talk about in this investing podcast that we're doing here, is that investing is a different game than trading. When we are trading, we are identifying an asset. We are going to be buying it or going short in it with the expectation that it's going to do something over a certain time frame, and then we're going to get out. We are only interested in the price action and the profit, and that's it. And the only way we can win the game is to get that process right. What I really want to talk about in investing, and you pointed out diversification, don't have all your eggs in one basket. Investing is making money from things like diversification, things like compounding interest, where you're not necessarily like identifying the best asset to buy and sell at the right time. What you're saying is, I'm going to play this game where through diversification, through dollar cost averaging, and from being a good steward of it, that I make money. And it's not so much about the individual investments you pick. That is very important in trading. It's the most important thing in trading is what you pick. When you pick to get in it, when you pick to get out of it. In investing, you're going to win the game through compound interest, diversification, and time. And that's really the point, at least I wanted to get out in this podcast, because I think people try to play the investing game, but they don't understand that that's how they're going to win it. They're trying to do it through the trading game.
Yeah, and I think the main hope for all of you in this episode, for me at least, is to have everybody understand that if you don't think you have an advantage in the investing world, you actually do. For the reasons I just described, you have that rare trifecta, and there are lots of inherent advantages and disadvantages in the investment world. But like anything else, when I talk about taking risk, it's okay to take risk if you can find ways to mitigate risk on the other end. Then you can have all the upside, but a lot less risk. So let's attempt to do that a little bit today, Rob. And I'm going to start just by some general advice. And if you can just follow this general advice, I think you're just stacking more and more advantages on your side. But I just want to get rid of that paralysis for some people, because I know even with trading, there's some people that have consumed all of my material and haven't traded a lick, not even in a demo account. And so there's people out there that are very apprehensive. Understand that not in this environment, especially with inflation and how our fiat currency does nothing but get worse and worse, not taking action is far, far more risky than actually taking action. Inaction scares the hell out of me, because then I'm going to end up just struggling like everybody else, and I don't ever want to do that. So you need to start crossing over to this side, and you should. Just understand, too, that the one reason I didn't start is because I didn't want to take money out of my bank account and put it into investing. That scared me for two reasons. One, Rob, I would do something that I've talked about on this show before called taking a picture. Let's say I finally get to $2,000 in my checking account. I'm really proud of that. I'd never gotten there before. And now I'm there. And I don't want to see any lower numbers than 2,000 in my account ever again. I like the safety and the accomplishment of having that right there. But what a younger version of me doesn't understand is that if I take 1,700 of that and put it into some type of investment that makes sense in an environment where it's already going up, at any point in time, if I need that money, I can go grab it. But I couldn't get past that whole take a picture psychological hurdle.
I absolutely get that. And I remember thinking the same thing when I was younger. I want everyone to start thinking of investing as cash to asset to cash. And that's just how it all works. So unless we were all born to wealthy parents with a trust fund, we go out in the world at zero. So we all start, I shouldn't say we all, everyone's at different places with different backgrounds. But for the most part, everyone starts out at zero. When you are, let's just use 18. Let's just use 18. You wrapped up your schooling, your high schooling, and then you went out into the world. You probably had to go get a job. We all start out at zero. Yes, I know some people have advantages, but look, it's possible for everyone. At this point, you have to go get money. You have to go earn money. And you are going to be earning in cash. And just like Patrick said, your job is to try to save as much as that as possible. Now look, we're all human beings. We all have a life. We all need a place to sleep. We all need clothes on our backs. We all need food. I get that. And for some people, the reason why they never start investing is because they simply don't make enough money. If your cost of living, I remember as a young kid, cutting pretty much everything out of my budget and still not having enough money. Like I remember that. I remember it. But this is just math. You have to live on less than you make. Now, cutting back, I think, is the wrong thing to do. I think it's the wrong thing to do because whenever you cut back, it is a signal to your body that things are bad, that you're not growing, you're contracting inside. I think you have to look at ways to make more money, which would be other jobs, side hustles, something. But once you have more money in than you've spent that month, you have extra. We're all humans. We all like to treat ourselves to certain things, and we all need to do that, period. But some of that money has to find its way into an investment. It has to. And if you could do that from a young age, where again, you worked on increasing your income, that's why people go to school, that's why people go get certificates, that's why people get trainings to increase their income so they have extra, and they start to put it away. That's where everyone needs to get in their life at some point as soon as possible. And so, Patrick, you're exactly right. I think, we see that, and saving up that money is great, but it needs to be earning a return.
And I also want to get rid of the block in people's heads that they're worried about investing their money because the value of that money might go down if the thing they invest in goes down. This is true. That will never not be true. But we're going to spend the rest of the show talking about huge advantages that you're already going to have compared to the one major disadvantage you're always going to have with cash. And I just said it. It does nothing but go down over time. You want a surefire way to lose? Hang on to mostly cash. Now, don't get this confused with what I say in my investment podcast, how I'm stacking cash right now. There's a time and a place for it. But long term, look at any chart of any currency in any country. It's all the same. It's a reason why people are struggling so much right now. I make this comparison all the time. I talk about oil or gasoline. I can remember my cheapest I can ever remember seeing gasoline was about 69 cents a gallon, give or take. It was when I was in college. I guess I just paid attention more of it then because it applied to me. And, now on average in the United States, it's, $3.50 to $4, right in that range. What happened? Did it get more scarce? No, it didn't. It's actually a lot more abundant now. Did it become harder to produce or harder to dig up or refine? No, all of those things have gotten easier. And supply and demand has pretty much stayed the same. So why is it so much more money now than it was then? It's because our currency has gotten worse. I want people to understand that. And it's going to continue to get worse. In the United States, all we do is print. In every other developed country, not named Russia, all they do is print. So you should be scared of that, hopefully enough to go out on your own and take that cash and all the cash you make from here on out and put it into something that makes a lot more sense. And the good news is everybody in the world can do that right now thanks to the blockchain. Everybody can invest in Bitcoin. Everybody can invest in gold on the blockchain if you have absolutely no access to it anywhere else. And even on a place like Uphold, I'm not sure how many of you are familiar with this or how many people in other countries have access to this platform, but they have synthetic stocks and ETFs you can actually invest into. Now, I don't think you get dividends with these, but the access is still there. So you can take that excuse out of your playbook now too. There is just really no reason for people not to take this very, very logical step.
And let me add in fractional shares and no commissions. 20 years ago, if you only had $15 a month, that's all you had extra. You literally could not put that into the stock market. You couldn't. It couldn't go anywhere. It just wasn't enough money. Now, You can buy fractional shares and it costs you zero in commissions. Everyone, every single person can start to put something away as long as you make more than you spend. So again, that I don't want to, we can't spend a whole bunch of time on that, but I want everyone to understand that's the math. If you are spending as much as you make or more, you got to fix that. You got to fix that. I don't like shrinking. I don't like the pinching down and pinching pennies. I just think that sends a really bad signal to your brain that you're in crisis mode and you got to hold on to everything. And you know, Patrick, you know, whenever you went gambling, when you were flush with cash, you always won. And whenever you were broke, it was tough to make a right decision. Would you agree with that?
I don't know about the first part because I lost a lot, but that second part's very true. When you're living and dying on those bets, they just never seem to go your way, oddly enough. I don't know why that is.
Yeah, so again, the math is you've got to have extra, and everyone, even if it's $10, even if it's $15, you can go down to a local coin shop and buy a $15 coin. But here's what I do know, and I know this from personal experience. If it stays in your bank account, you're gonna spend it on dumb shit. And here's the crazy thing, Patrick. You talked about how people don't want to spend that $2,000 and put that into an investment. But you know what they will do? They'll go buy a $1,000 couch or a $2,000 couch. Do you know what that couch is worth the second you buy it? The second you take it home, and that's a used couch, at most $500, at most. And probably less than that. If you own it for 3 years, it's going to be zero. That couch has no value. We have no problem spending $2,000 on stuff like that will definitely go to zero. Spend it on investments. I'm telling you, that's just the key.
That's just rich people, poor people mindset. You know, those are things that poor people do, and that cycle perpetuates, and they can never ever get out of it. You know, coincidentally, on the rich people side, the reason why the gap is getting so wide right now is because, you know, you and I talked about this off camera, Rob. Look at some of these places to where, you know, the rich are getting extraordinarily rich and literally everybody else is poor. Places like Venezuela. You hear nothing but their currency crashing and the dictatorship and stuff like that. Have you seen their stock market? You know, it goes bananas. When you devalue the currency, the stock market usually does really, really well. You know, you can just look no further than Japan for that. So, you know, you can decide which side you want to be on. But I've made my choice, and I think everybody here has also made theirs. Just don't be afraid to step over to that side, because yes, it does involve risk, but staying on the side you're currently on with mostly cash is far more risky. So now that we've gotten that out of the way, just know that this transition, whether you're doing it for the first time or whether you're simply putting more over on the other side, should not be that scary, because everybody thinks there's a lot of disadvantages in the stock market, and there are, but they're not. One, they're not that bad. Two, they can be mitigated, leaving you with all of the advantages. So let's talk about some of those advantages now. First of all, and this will be this way probably for another 10, 15 years. You know, Rob and I talked about this too. You know, I think we got at least a good 10, 15 years of a long-term bull market. And if you can just wait out the recessions or put your money on the sideline or do some other things we're going to talk about in this episode, you can enjoy this bull market. And if you just plop your money into almost anything random and just keep it there, you're going to do well. But you can also utilize a lot of other advantages we're going to talk about today too, to damn near make sure that that investment has a very high probability of going up over time, while your cash on the other side is just going to sit there and continue to lose.
Well, Patrick, it's actually probably been about a 500-year bull market if you go back and look at history. Now, it's probably been a longer bull market than that. The problem is financial markets, as far as, you know, where we can trace back the history to people actually buying and selling shares of stock. Real estate has been around forever. That's been in a, let's call it a 6,000 year, and I'm not saying that's how old the earth is, but 6,000 year bull market in real estate. Now look, there's been panics, there's been crashes, there's been periods where it hasn't been good, and I get that. And that's what scares people. But look, as long as you got in, you were fine. And just take a look at this. I mean, my kids turned in their 20s after COVID. They're looking at trying to buy a house, and it is unaffordable. It's just unaffordable. How many people have said, oh, I wish I would have been able to buy a house before COVID? Now, my kids just weren't old enough. They just weren't old enough. But there were people that were old enough that were scared to buy that house. And they are kicking themselves for it now. When it comes to investing, there is no good moment to get in. It's more important just to get in, even if it's near a top. Because the risk is that you're going to be sitting there and be priced out of the markets. So look, this bull market, there is no guarantees. So we could look back 2,000 years and be like, hey, look, it's been going up the whole time. And yes, there's dips and falls, but for the most part, anyone who's played the game, anyone who started investing in their 20s, by the time they were 70, they did very well. There's no guarantee, but as far as guarantees go in the financial markets, this is about as good of a one as you get. If you are committed to putting money into investments your entire life, anytime you earn money, yes, you can still lose, but it's going to be very, very, very difficult. So like I said, I don't even think you should be scared because this is the closest to a guarantee that you could possibly get. And again, you're not trying to pick the best things. Buy at the high. I don't care. Look, if you started investing in 2008, the worst time ever, but you said, hey, I'm going to put X amount of dollars or X percent of my income into the stock market every month for the rest of my life. And you started in 2008 and you didn't chicken out and you just rode it out and you were buying the whole time the market was tanking in 2008. And then in 2009, it was really ugly. We had a couple of panics in there, but you just kept buying and you did that for the last 10, 15 years. You won. You won. And that's why I said earlier, in investing, you need to understand the game. You're going to win this game not because you picked a good investment. You're going to win this game because you picked an investment and you're committed to it throughout your entire life. There's so many advantages. Again, I cannot stand up here and say it's a guarantee that in 50 years the stock market is going to be higher. Because I can't say that because there is a chance. But if I ever said it at any time in human history, I was right. So I could be wrong this time, but as far as a guarantee, this is as close to a guarantee as you get.
And this flows really good into the other point I want to make because I don't completely agree. I mean, I hate the word guarantee for one because that speaks to people who are like super, super risk averse. And risk averse people mostly just hold cash. And that's one of the reasons why I don't know any risk averse people who are actually doing well. You know, they are that statistic on financial news of people who can no longer afford a house and have to get 3 jobs and can't have kids because they're never around, things like that. That's what risk averse people look like. That's what they do. I am not going to be one of those people. I don't love you're not wrong technically, but I don't love the fact of like knowingly buying at or near a top because it's all going to be fine in the end anyway. I think there is a very distinct advantage, and we talked about it earlier in the show, that almost everybody has here. And that is in your technical analysis. Do this for me. Scoot all the way back to the monthly time frame and go to the S&P 500. Put any basic ass trend confirmation indicator on your chart and tell me what you see. You should be able to reasonably determine, barring something completely out of nowhere, when an economic downturn is going to happen and when it would make sense to take your chips off the table. So if you want to do what Rob said, even though I think we're in a midterm bull market now, but we're due for a recession and that's fine. But I'm still risk on. I'm still bullish. I still hold the QQQ. And when my chart tells me not to anymore, or if I start to see smoke where there's about to be fire, I'll let it go at that point. We are skillful enough not to just have to sit there and take it when the market drops, like most people do, not just to sit there and eat these losses. It doesn't have to be that way, and that is an advantage that so many of you have, and if you simply utilize it, the fear of losing all of your investment or even a good part of your investment, much of that goes away.
Amen. I agree 100% on that. And look, I don't want anyone to be taking what I'm saying here, right? Because I hope everyone understands I'm just really trying to encourage everyone to start today if you haven't already started. And if you've already started, just keep going. And I'm just trying to show you the biggest risk is not getting in the game. But Patrick, you're right. We're smart. We've put a lot of time into trading. We've put a lot into learning about financial markets. We know a bubble when we see it. We know these things. So we can absolutely take advantage of it. But this is where it is now, it's not about like getting in a position and selling it. It's about diversification. And this is what we're talking about, diversification. So let's say that I am managing my portfolio and it's my investing portfolio, and I think there is a bubble in the stock market. Am I going to sell everything and go to cash? I could. Or could I sell some of my riskier holdings and put those into a bond fund and put some over here into safe dividend stocks? I can absolutely do that. And then if and when the market crashes, those investments go up. And then when it bottoms out, I say, hey, let me up my allocation to riskier investments. So you can see you are still trading, but it's not like the trading we do on our accounts where we take a position, put in our stops, sell it at our target, and then go back to cash. It's different than that. You're simply reallocating everything to where you think is the best opportunity at the moment with the least amount of risk. So I just hope everyone understands what I'm saying here is that you're not just going to be like the lemmings out there who are just buying every single month and just hoping and praying that it all works out. Now look, if you do that, it's worked out in the past. Pretty good for people who did that. So again, the most important part is you play the game, but we have so many things that we've put in time and a lot of work to know these things to where we can make allocation changes within our investments.
Yeah, and even if you're not as skilled at this investing game as Robb is, you don't have to be. You can do things on a very, very basic level. You can simply enter and exit the market based on what something like the monthly chart says. I love the monthly chart because also, like we do for the daily chart in trading, a lot of bad news, for example, can be absorbed by simply zooming out. Tesla, Robb, was a great example. I was looking at Tesla and I got a signal on the monthly chart to buy Tesla at the early start of last month. I didn't get in it because I'm investing in other things right now, but I was tracking it. I was looking at it and I was like, okay, it's a go. Let's see how it does. And then all that month was nothing but Tesla FUD and how people were super bearish on it. And I was like, okay, the price is going down. I still got the signal. I would still be in normally. Flash forward all the way, another, 20, 25 days, Tesla's way up. So it's just, if you zoom out enough, like I said, the daily chart is a lot more accurate than the 15-minute chart in terms of your technical tools. It just is. The monthly chart is even better than the daily chart. It's going to lose every once in a while, but it's super, super accurate. And then when you pull your money out, you can put it into cash. That would make sense, especially if you're looking at the overall market itself. But, if we're going to go through a long-term recession, maybe 1 or 2 years, possibly more, historically, Robb, there have always been things that do really well during a recession. One of them in particular I'm thinking of is energy stocks, in particularly oil. It just always seems to do really well. So you can squat in cash and be safe, or you can just rotate it into something else that's just going to keep going up too. It's not always going to happen, but you really, really, really have history on your side.
Yeah, for sure. And as you were talking, I just came to the realization of how we look at this differently. I personally don't think anyone, I shouldn't say this. Let me rephrase this. I think using asset categories versus single stocks is a way better way to invest your money. I'm talking about ETFs. I'm talking about index funds. I'm talking about things where you can put a lot of money into them. Here's the problem. When you have a small amount of money, it makes sense. But when you are trading with hundreds of thousands or millions of dollars, and you're looking at, you want to get 100% of your money invested. Now, if you're trading 2 stocks, that's way too much. That's way too much risk. That's incredible amounts of risk. However, if you are using ETFs, you can put 50% of your portfolio into the spiders, and you can put 50% of your portfolio into the HYG, high yield bond fund. Like, you can do that and not be crazy taking risk. But again, I know people do it, and I'm not saying you can't do it, but I think taking individual stocks in your investments is one of the reasons why people get scared, because on any given day, your stock can get some really bad news on it, and it can gap down 30, 40, 50%. Especially if you're trading stocks like pharmaceuticals or biotech. Those can be really nasty. But if you're buying these spiders, the worst gap I've ever seen in my life down was 10%. And it recovered very quickly. That was in like 2016, January 2016. And by the end of the day, it was down 3%. You can put a lot more money into things than you can with the trading mindset. And I guess that's where you and I look at things different. I would never buy an individual stock in my investments. I just don't do it.
That's a really great point. Yeah, we're not saying go out and buy Tesla because there's a lot of variance there. Now, honestly, in a bull market, it's probably still not going to matter. Like I said, the fundamentals on Tesla have been trash for a while, but we're still in a bull market, and my chart says to go, and that is almost always going to trump bad news for particular stocks. It's not going to trump a diseased company, a rotting company from the inside, but it's magical what bull markets will do. And if you can, just by looking at the S&P 500, simply determine that we are in one, it's pretty hard to lose. And if you do what Robb said and keep it basic and keep it into those indexes, simply by doing that, you're doing so much better work for yourself and for your money than you are by sitting out for no good reason. So now that I hope people have a better idea, I hope some of you already have, I get this, but I don't know who I'm talking to. The Forex market and the trading market is a big world with a very diverse group of people. So, hopefully we've kind of explained to you that there's really no reason to be scared. And if you're going to be scared, taking no action is probably the scariest thing you can do at this point. And once you come over to this investing side, there's a ton of advantages that are already built in that are going to suit you really well. And so you can almost, I hate to say it, almost practice and make your mistakes with your real money. And even if you lose some money on those mistakes, it's not going to be that bad, really. But I think everybody should be doing this. Now, in terms of actual psychology, which that's what this episode is about. I know it hasn't seemed this way up until now, but there's a number of things you can do here to, as we said before, get an edge on everybody else. Increase your odds even further. Robb, what is one of those things? I have a couple I'm going to add too.
I want to go back to my rant at the beginning. And remember I really get heated about this one. My rant in trading versus investing. And I hope you heard or at least could feel my, I don't want to call it anger, but my intensity about this is that in trading, we take our cash, we buy a trade, we work that trade till the end, and it's a gain or a loss, and then we go back to cash, and then we look for something else and do it again. And I said, okay, that's trading. Investing, if you look at it the right way, it will fix all of the psychological problems, because I don't think you should be trading your investments. Because like for me, if let's say that I am in the queues, and let's say the queues give me a signal that it's no longer right to be in the queues, I'm not going to sell and go to cash and then sit there for 3 months. I'm going to go and put that into a bond fund, earning 5.5%, maybe 6%. Why would I put it in cash when I could put it over here in this bond fund? Or, you know what? I could even put it in the inverse of Qs. I could put that in the inverse of Qs and go short the Qs and make a little bit of money if the market goes down. But do you see, I'm never going back to cash. The thought of trading is you take your cash, you go buy something, and then when you're out of it, you go back to cash. That's what I'm really talking about, is that's not investing. Investing is moving your money around. Okay, I want international. Hey, international is a better place to be right now. I like international. All of a sudden, hey, international is not so great. I'm going to go run and hide in bond funds. For me, going to cash just doesn't really make sense. Now, yes, cash in a brokerage account is going to earn money market rates, which are better than cash in your checking account. But you can park that money in like SGOV. SGOV it's a short-term government bond fund that pays like 5% right now. That's where you should park your cash. And then when all of a sudden, when you think there's a better investment, you're going to move it. Now, if you think about it in that way, all of the psychological things that come up with trading about, hey, am I right? Am I wrong? Am I getting the timing right? Am I getting the timing wrong? They kind of go away. They go away because everywhere you're moving it to is there's not a lot of risk. You're using ETFs, you're using index funds, you're using things that have really low costs. And yes, you might get it wrong and you might park it in the bond fund while the stock market rallies 20%. Look, that's going to happen. But guess what? You still made a return. And as long as you're putting new money in and you're reallocating it, you're going to do so well. And that's why, again, for the psychology part of this, if you understand the game you're playing, I just don't even see any of the psychological issues from trading coming into the equation, because you're not trading. This is totally different. You're simply reallocating money to certain places. And yes, sometimes you're going to miss some things. Big deal. You're putting new money in all the time. It's growing all the time. And as long as you don't really screw it up, you should do pretty well in your life.
You really should, and that's kind of what the psychological part here is all about. Is kind of because the main psychology that comes into play here is fear and uncertainty, because people just don't feel like they have a really good grasp on this market. I mean, for God's sakes, when I was growing up, you had to go to a good college and study the market for 4 years, and then take an internship, eating shit at a big brokerage firm, and learn on the floor that way, and then only then were you good enough to be able to pick stocks. And it's just not that way anymore. But I still think people have that idea in their head. Like what Robb was saying. Let's say you want to rotate into oil stocks or international. How will you even know when it's time to do that? Your chart will tell you. Plain and simple. And then if you want to drill it down even further and look at ETFs or even individual stocks, that can be daunting. I get it, because this is not your expertise. This is not something you have a lot of experience in. But guess who does? The analysts who work at a lot of these free companies. When it comes to fundamental analysis, it's not the best, it's not the most comprehensive, but it is quite good. And they will do all of the work for you. And it costs you absolutely nothing. And a lot of these places that I'm about to talk about, they've shown. They say, look, take all of the stocks that our analysts liked and all the ones that they didn't like, and let's put them head to head. The ones they've liked have really outperformed and done really well. So, Robb, if you have any to add here, the ones that I see are the ones that I've seen that I've actually liked and are pretty easy to follow. Yahoo Finance has their own analysts, all free. There is a stock screener site that I know Robb really likes called FinViz, and they have their own in-house analyst, and you can sort all the stocks they like and all the ones they don't. There is a company called Zacks, Zachs. They even have an app. And they actually do more than just give a rating. Sometimes they'll actually tell you why, which for free is not something you normally get. Usually you have to have the paid versions to get like a deeper analysis. And then check your broker. I'm with Charles Schwab. They have their own analyst, and that analyst will tell you if they approve in the thing that you're looking at before you buy. And if it's a buy or a hold, I typically go ahead. If it's a sell, I take a step back and I want to see if he says anything about it. Or I want to go to Yahoo or Zacks and see what they say about it. And say, okay, if enough professional analysts that do this stuff for a living are not liking what I'm about to invest in, maybe I should just mind my business and go look somewhere else. This is just another advantage, another fear that we can almost completely take out of the equation because we don't know how to do these things ourselves. Robb, are there any additional sources that you can give here that you like in terms of fundamental analysis? I know you're good enough to do this yourself, but you've also put a bunch of years in, and most people haven't. So if you were one of them, where would you go to for a really quick and easy recommendation or de-recommendation?
ETFs, index funds. Look, they've done lots of studies. You're just fine in them. You're just fine. Again, do just a little bit of basic research on ETFs. They have ETFs these are just stocks that follow certain indexes. So the SPY is a stock. It follows the S&P 500. So whatever the S&P 500 does, that's the return you get on your stock. They have thousands of these ETFs. There's biotech ETFs. There's triple leveraged ETFs. I mean, there's so many ETFs here to where you can then just kind of invest in a theme. So let's say you say, you know what, I really think AI is going to be a big thing, and I want to invest in AI. Now, going out and buying any one AI stock is very daunting because some of these stocks will go to zero. They will. I know that for a fact. Anytime there's new technology, there's going to be a whole lot of companies that go out of business. I mean, just think about social media. MySpace went out of business. The first one, it went to zero. I don't think it was ever public. But the point is, when you use these tools, all of a sudden it becomes a lot easier and it's not all that scary to buy 500 stocks at once, 1,000 stocks at once. And you can start really investing in themes that you don't even need to know charting. You don't need to know fundamental analysis. You just need to be a human being looking around saying, hey guys, has anyone noticed there's not enough housing lately? I wonder what housing is probably going to do over the next couple of years. We're all smart enough. Guess what? There's housing ETFs out there. Use these. And I'm in a totally different place right now than I was when I started this podcast, because in my mind, investing is how you should do it. And then I thought of someone who was trying to trade in their investment accounts. And I thought to myself, oh my gosh, why would someone do this? Because if you're trading, then that means you're following proper position sizing, which means that your positions are like 1% of your account. What is the other 99% of your account doing? Okay, you're doing 10 trades at once. Great. What's the other 90% of your account doing? So my guess is what someone is doing if they're trying to trade their investment account is they're probably over position sizing, and all of a sudden that's trading. And all of a sudden all that fear comes in that if you don't get it right, if you're at 50% position size and you get that wrong, it's going to kill you and you're going to get into all of those things. I didn't even think that that's how somebody could handle their investment account. That's just how far removed I am from it. Now I finally understand, this is where my rant is coming from. Trading is trading and investing is investing. Investing, these tools, these ETFs, are really the only way that you can get 100% of your account on the line. And that's what you want in investing. You want 100% of your account invested. Now look, it could be invested in an income fund that has no risk of the stock market, but it's still invested in something. It's got to be invested 100% of it, 100% of the time.
So yeah, if you can just do some really basic things here. If you don't treat it like actual trading, but you still use the inherent advantages as a trader that you have, So technical analysis, basic money management principles, solid psychology. If you keep it simple and don't go crazy, like Rob said, I'm a big fan of ETFs too. And if you use those fundamental analysis services that are free to you, and yes, a lot of them also rank ETFs. If you just combine those things, there's no reason to be worried about any of this. There's no reason to keep most of your money in cash. It took me a long time to get here because I was so proud of the cash I was making. But when I really broke it down, that was just more and more cash I was losing to the devaluation of fiat currency over time. And I got wise. And I'm really, really glad I did. And for what it's worth, if you don't listen to the 10-Minute Contrarian Investing podcast, I will be going over some of these concepts even deeper in the next couple weeks. So mark your calendars for that. But for now, thank you, all of you, for sitting through an investing episode of the Trading Psychology Podcast. Rob and I will see you next time around.
Goodbye, everybody. Keep investing, start investing, just get in the game.